What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 18th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and welcome yet again to another Macro Monday here on the DataDash channel. We've got an exciting one here today as Bitcoin has gotten up to its highest price level as far back as June 15th, nearly in a month of price action. So we need to talk about what this means. Are we in a major relief rally across the board in all asset classes? That's a big part of what we're going to be talking about today. We're going to be discussing the relief rally, Ethereum, and how it's leading the way, whether or not equities will follow in this trend, and how we're watching the FANG stocks as a major market leader, and outside of that as well, the Fed meeting coming up next week, and why I think that the Federal Reserve's next set of moves are going to make this nothing more than a relief rally in the market rather than a long-term recovery. If you happen to enjoy this video, consider dropping a like, consider subscribing, and let's go ahead and kick things off here. Now, I want to go ahead and take it back here to the Bitcoin chart. This is the first time, just to really point out the magnitude here, the first time Bitcoin has been able to get above its 4-hour 200 EMA since as far back here as April of 2022. Months and months of getting pushed down by this moving average and not being able to hold above it. We have now finally broken above this range. And on top of that, it would be one thing for Bitcoin to be leading the way and seeing confidence. It is another to see Ethereum garnering even more confidence. We have clearly broken out of what was mainly originally seen, I think, by many traders as a bearish breakdown of a usually bullish pattern, an ascending triangle, but was swiftly recovered after the market strength coming out of the CPI number release. Even though the numbers were abysmal, the price came back up here, and we've been going through what cannot be ignored as a short squeeze. This is a clear and present squeeze on all the people who for the past month have been trying to bet on the market going further down. Now, you all know we think long term that the market is going to continue to remain low here. The long-term effects of inflation and all these pressures are going to eventually weigh price back down. But in the near term, we understand that it's silly. It's a fool's game to try to short the market this low. And we warned about that in our previous CPI video. We talked about how the relief rally here over the next coming days and weeks going into the later part of July and potentially early August is going to push prices higher here easily for Ethereum into the $1,700 range. And if we really start to see a resiliency of optimism, both with Ethereum going into its upcoming ETH merge on September 19th, that's at least what it's planned for. As we all know, Ethereum can have many delays, but hey, it's buy the announcement, sell the actual news, sell the actual event that comes out, right? So these things have been pushing price higher here, and it's been pushing the ETH to BTC ratio above an ascending channel that many people originally thought was broken here to the downside. We have now gotten in, if we want to take it here to the daily, we are now back within the 200 EMA and as well as the 200 MA on the daily time frame. This is where I expect some sideways chop. I think we're going to contest in this range, much like we did here back in the past many times. And in the meantime, Bitcoin will probably be keeping relatively neutral with Ethereum's price action. But this could also mean that we start to see a lot of positive upside in the broader altcoin market. And that's my next focus point here. As Ethereum, and therefore Bitcoin afterwards, have started to lead the way, chartering higher here, I think we're going to see a lot of altcoins start to benefit from this increase in value and liquidity. The reason why Ethereum and Bitcoin have led the way is because of the derivatives markets and the exposure to leverage that investors have over these assets. They're much more liquid markets, and because they're much more liquid markets, there's a lot more derivatives products around them. So now that we've gone through a pretty massive short squeeze here, I expect that we'll see the broader market start to play catch up with these plays. And this comes in, if we take a look here at one of our data science partners here, CryptoQuant, that has a lot of great charts through its Pro Chart feature, there is the taker buy sell ratio MACD on an inverted scale. I know that sounds really fancy, but as you will probably remember, as we've talked about, there are two things that really dictate price. There are taker orders, or basically market orders, buying a position or selling a position at the best available price offered from the other matching trader. And there's also bids on the order book, limit and ask orders. And essentially, that taker volume is going to apply a lot of pressure on the direction of the trend. And we can see that it typically means when we get down into this range on the MACD that the longs are starting to prevail here. We can see as we started to get towards these extreme ranges here, where buyers are really starting to outweigh sellers, this is what drives a lot of the rallies here. And only when we start to get to the heightened range, when many people think that overall we're starting to get into ranges where there'd be a lot of buy-side pressure, the MACD here showcases that essentially the trend is setting up for a reversal. So we can see that we're setting up for higher levels here according to the metric, and it is a clear telltale sign that the bulls are in charge right now. And there really isn't any critical resistance for Ethereum until about 1700. Does it mean that you should absolutely rush in here or that you should go all in or trade crazy amounts of leverage? No, right? Might be good to wait for a slight cool down, a slight pullback, and to not toy with wide ranges of leverage. Keep it conservative. There's nothing wrong with just trading spot or trading with very moderate degrees of leverage. I don't recommend it here, guys. You guys don't see any referral links to any of these exchanges. I'm not going to promote that here for you. I want you to play it safe and make some good returns. Now that we understand that the relief rally is here, the optimism is likely going to continue going into the later part of July and potentially early August. The next question is whether or not equity markets are going to see the same. And by the way that the futures are trading here, as we're taking a look at the pre-market trading essentially through the NASDAQ 100, we are already up, I think about a percentage, about 1.3% here off of the previous close of the futures on Friday. And it looks like we're pressing up to the highest price range we've been at since June 10th for the NASDAQ. Now, as this range has been a pretty big consolidation point, once we break through this, it is likely that we're going to come up into this range on the moving averages for the daily time frame. And that is the relief rally opportunity I think we're very well going to see here. Because what we've seen coming out of the CPI number release is that I think, as we tend to see before every relief rally, that the vast majority of people who've wanted to sell over the past few months are out of the market. They had that opportunity here. Many of them manifested here during this sell-off here. And price has generally been pushing sideways for the NASDAQ since as far back as May of this year. Nearly 2 months here, over 2 months, that we've been pushing sideways. And there's a lot of people who have been getting short. They've started to revenge trade essentially, betting that the prices are going to go lower. And this is the perfect setup here. Even though we think long term that there will be a recession, the reason why we don't get too confident that things are just going to move in a straight line is because they don't. Essentially, there are going to be periods of time where the bulls take back control and drive prices back up. There are many people who think that this is the worst that is going to come, whether they are institutional or retail investors, and they're going to drive prices back up into this range. Now, if you guys want a little bit more details as to what we're targeting here, we're looking for some resistance to come in around these moving averages. And lo and behold, it's coming right around this descending line of resistance that takes in the two previous significant highs that are lined up here. So somewhere around this $13,000 point range on the NASDAQ is what we're looking for here going to the summer. And if you guys are interested to learn about some of the equity trades that we are going to be placing potentially in the market, you guys can definitely check out the Dash report down below in the description. I'll talk a little bit more about it later, but it's our newsletter here on the channel. Essentially speaking, there is going to be opportunity across the board. I think this is going to be a rally specifically led by the NASDAQ and technology companies that are really at oversold territory. And on top of that, we are going to see the Dow Jones and the S&P 500, a lot of the major industrial plays, all kinds of companies start to see a bit of a relief rally as the market is starting to expect that the Federal Reserve is taming inflation. Although we do disagree long term that that's the case. We'll get to that in a little bit. Why am I bullish here on the tech stocks? Why do I think the FANG stocks here give us some opportunity? Whereas Apple here might, for example, be a bit overextended already, it has been really the market leader here during this rebound in the market, really starting before a lot of the FANG stocks. right? I don't think that there's a huge value opportunity here in Apple as we are coming up towards the moving averages, the 200 EMA and the 200 MA, which were serving as support before. I think we'll just probably chop sideways here, maybe push a little bit above it. If anything, I think a lot of the value opportunity comes from a lot of the oversold technology plays, right? Because again, we are just trading a relief rally. Usually I'd say buy the winners, right? If you're holding positions for the long term, buy the winners here, the ones that are holding up well. But to be honest with you all, we're just simply trading a relief rally here. So what we want to look for are the plays that have the opportunity here, the alpha, to essentially be able to move higher here. Let's go ahead and take a look at Meta, for example, right? Meta Platforms, down 57% still from the all-time highs. Major move down here. We got some gaps that could easily be filled here, starting to move up higher towards the 200 range. I think a lot of these technology companies are going to come back up, as crazy as it might sound, in a pretty exacerbated rally towards a lot of these moving averages. They are steadfast to the downside, and I think that we could get a very easy short-term relief rally back up into a range of previous price from back here in Q1 against these moving averages where they will get knocked back over again, right? Something where the Qs, these technology companies, will get hit down by these moving averages that are starting to decline over time. But it'll still give us a great potential reward period for a lot of these tech companies. And it's going to trick a lot of people into thinking that this is the end all be all of the crash, that we're starting to move higher, that this is the time to go long, take a lot of risk on, and stay in the market. But all the while, the first 2 points might be correct. The third one likely isn't, right? And we'll get to that a little bit in the macro conversation. But I mean, just take a look here. We got Tesla as well, down around 42% from the all-time highs. Moving averages at a nice distance here for a move anywhere from around $800 to $900 per share. We've got Google as well, another cash-rich technology company, down here about 25%. Of the lows here, about 26%. Nice discount opportunity. And I think as well, we've also got Amazon, which is down about 40% from the all-time highs to where it is now. So these are some plays here that I think are clearly, after pushing sideways and consolidating for some time, they're signaling very clearly that anyone who wanted to get out are out by now. And I think a great example of this that's like the most exacerbated within the technology companies that I'll be watching is Netflix. Down 76.9% from the all-time highs to the relative lows here, and still down about 73%, with a huge gap to be filled right around those moving averages. I'm not saying it's going all the way up there, but I have to tell you all, with earnings right around the corner, I think tomorrow on Tuesday, and a lot of other companies starting to release quarterly earnings, I think that this is going to set the foundation here for a short-term relief rally. Now, I know a lot of you are probably wondering, why do I think there's going to be a relief rally here? We just had terrible CPI numbers, right? What fundamentally could set us up here for the move higher? Well, the first point is what we talked about before. You don't always need fundamentals. It's a matter of supply and demand, essentially sellers and buyers in the market. And if we've gotten most of the sellers right now out of the market for people who want to sell right now at these prices, then if buyers start to outweigh, prices move up. It's as simple as that. Markets don't have to follow direct fundamentals because, technically speaking, not everyone has the same perspective on the fundamentals. We think long term that it's going to continue to probably go down. We're going to expect the worst here, that we are going to get some kind of 40-50% recession across the board in equities. But we know that it doesn't happen overnight. We know that there are periods of time where people start to flip their coin. They start to get more emotionally positive rather than negative. And that's exactly what can set up the foundation for a lot of these technology stocks, which have been pushing sideways, to really start moving higher very quick. Again, same principle applies here. Anyone who has shorted within this range, if this pops up 5-10%, is going to knock out a lot of people, and that is going to cause a short squeeze, which drives prices higher here. Again, don't take my drawings at face value here. We don't know exactly how it's going to play out. But essentially, we're betting that it's going to start going to the upside, and we're going to start positioning ourselves, right? So that's a very key thing here. Now, on the fundamentals perspective, we have a major event coming up here. between July 26th or the 27th, we don't always know exactly what date it's going to be, this is the next FOMC meeting. Between the CPI number releases as well as the FOMC meetings, these are your two major macro events to look for in a given month. We had the CPI number release previously, and now we've got the upcoming FOMC meeting where the Fed is going to announce whether or not it's going to raise interest rates by likely 75 basis points or 100 basis points. Now, a lot of people started to get a bit cautious back a couple weeks ago that the Fed was going to raise the federal funds rate by 100 basis points. Interestingly enough, though, there's been a lot of comments and statements from members of the Federal Reserve that that is simply just out of the question. And while the prediction markets were starting to increase around 100 basis points, I'm going to go ahead and say with a pretty decent degree of confidence, although you don't have to take me at face value, I would put my money on the Federal Reserve only increasing by 75 basis points and mentioning that they are likely going to start lowering the basis point increases of the federal funds rate to 50 or 25 in the preceding months. And this meeting itself is going to be the solidified catalyst to be able to drive equities higher. It doesn't mean that we can't start moving there sooner. Right, we can start the breakout beforehand, but this is what's really going to help carry it forward into the second or later stage of this relief rally here. That's what we're estimating here, what the Fed's going to do. Now, this is going to be next Tuesday or next Wednesday of the following week, so it's not coming up this week. But I think a lot of the market is excited that the Fed is going to do this, looking at the decline in energy prices after building a technical wedge holding up in this $100 plus range for the better part of this past year. We have seen now that oil has failed a technical breakout on the wedge. If we take a look at the more detailed time frame here, going to the daily chart, we've come down here, we're hanging by a thread on these moving averages. We faced resistance here at previous support, rejecting price lower here, and it looks like there's a very good chance that we could cool down in oil prices. I don't know exactly how it's going to play out. I don't want to bet too confidently here that long-term oil can't come resurging back higher, but at least in the short term, there's very clear technical weakness in both oil and natural gas, both respective for their commodity prices. And that's just irrespective of what you believe long-term. The technicals don't lie. This is a very, very negative pattern here. If we take a look here at the annualized chart, right? Just looking at this in the macro perspective, this really looks overbought here with a very tall wick for the price action here. We can take a look at the quarterly here as well. Again, if you're looking at this chart here, if you were thinking about this as a cryptocurrency, right, what would your thought be? Well, even if you thought it might go up higher here and maybe break up to new all-time highs, what I would estimate is that as we're at temporary resistance, we got to have a bit of a pullback. We got to make support on previous resistance at this range here at around $75. And from there, start to whipsaw higher here. Again, we don't maybe need oil to go all the way down there, but we should expect some kind of cool down, especially considering the existing price action here that's going to set up the foundation for the next move higher in oil, right? There is a very clear set of fundamentals that have got people worried, but things don't happen overnight. The world isn't going to go to complete disaster tomorrow or face an imminent recession within a matter of a couple days. It's just not how it works. Dominoes slowly start to fall over time. And the problem of what the Federal Reserve is going to do is that they are going to provide this cushion, this relief rally in the market. And the problem with that is it's going to lead back to the same problems that caused inflation in the first place to be so exacerbated. Higher consumer spending, more demand than supply in the economy. And it is going to put us in a position where the Federal Reserve is going to have to be, after kicking the can down the road, they're going to have to be more aggressive yet again. And this is the continued mistake that the Federal Reserve has made time and time again. They should be raising the federal funds rate to 100 basis points. They should put some temporary pain in the housing market because there is such a supply shortage available in homes. And they should try to keep people from taking mortgages, taking business loans, slow down the economy, and stop that consumer spending. But they're not doing it. And it's just going to lead to the same problems over and over again. And this is exactly why. If you look back at the 70s, there were multiple cycles of inflation, double-digit inflation for the Federal Reserve. They've done this before, And it looks like they might just be repeating it again. But hey, it doesn't mean that we can't take a benefit from this relief rally to de-expose ourselves as prices move back up higher, or take some additional trades right now, get in the market quick and get out just as quick. So that's the current mantra we have. Now, if you guys are interested in trying to capture this momentum here and follow what I do when it comes to trading these relief rallies, you guys can definitely check out the Dash Report. This is our monthly newsletter we drop every single month, usually around the first or second day of the month, where we kind of go over our summarization of what we think on crypto markets, equity markets, Forex, and commodities. And on top of that as well, you guys will be able to see my portfolio allocation for cryptocurrency positions as well as equities. And on top of that, to make matters even greater, we also do some mini market updates that we send out towards our members. Our members have been really liking that. As of recent, it's a new thing that I've been trying to do just to kind of give some additional extra insights on top of these weekly macro updates and more frequently as well. So if you're interested in that, check out the link down below in the description. You can get 20% off signing up for an annualized basis. But above all, I want to know, did you guys enjoy this video? If you did, drop a like, consider subscribing, leave a comment down below letting me know your thoughts, whether you agree or disagree with me on this. I think we're turning into some pretty exciting times here in the market, at least in the short term, to be able to make some great returns. But even with that, it also could provide yet again another great shorting opportunity down the line, and we'll wait for that right technical setup to come into play. And then from there, we can find yet again another buying opportunity much lower in the preceding months. But we got to be patient. We got to ride the trend for what it is right now. And until the next video, everyone, stay safe, trade smart, and I'll see you all in the next one. Take care, everyone.